What up, investors? My name is Slav, and I run a video log that takes 30,000 to a million. I've showed this account pretty often, and it's a public account. You can ask me any questions you want about it. But today, that's not what I'm going to talk about. My goal is to explain a call option, any kind of options to you, and I'm going to do it in a different way than anybody else does. I'm not going to talk about the right and the obligation and all that confusing stuff. I'm going to try to take a different approach and make an analogy to something we understand. Okay, so first I want to show you this graph, but please don't be overwhelmed by it. I will explain everything that's shown in here and what it means. Okay, first of all, this is supposed to be a lake. I drew this today to help you understand how options work, okay? And like real down to earth, like just me and you talking, we're spitballing, okay? This is a lake over here. And this lake represents all the value of your stocks that you have. Let's say you have $1,000 in your account and you decided to buy 100 stocks that are valued at $10 each. All right, that makes 100 shares times 10, $1,000 account. All right, so far so good. Cool. Now you have 4 types of options really that you can do. You can sell an option. You can sell a call option. You can buy a call option. In fact, let me go into the account and show you real quick. Let's go to Apple here. If you go to Apple and you go trade options, what you're gonna see is this little menu here. Then you're going to have 4 options here. You can buy a call, you can buy a put, you can sell a put, or you can sell a call. And with those 4 moves, you can construct any kind of complicated system for playing options in the market. You can do those options individually, you can do them as a group, you can do all 4 of them in some kind of formation. You can do multiple of each kind. You can do the same one with a different end date. It's called a calendar spread. All kinds of complicated stuff that you can just dig your teeth into. But first, if you don't understand options, how are you going to do all this? If you don't understand it conceptually. So my job is going to be to help you understand this conceptually. So let's go back to this lake here, okay? You can name it Lake Shasta. I don't know. Whatever your favorite lake is, okay? Now, the thing about lakes is that they change their level over the years, right? Sometimes we have a really rainy year and the lake goes up like 3 feet or something. Sometimes we're in a drought, the lake goes down 20 feet, and it keeps fluctuating like this over long periods of time. The same thing happens to stock price options. So stock price is kind of like the level of the water. It goes up, it goes down over time. And would you agree with me that it's more likely that the level of the lake is going to go many, many more feet down or up after 5 years than it is tomorrow, right? Let's say, for example, tomorrow it rains really heavily and maybe the lake gains like 2 inches, okay, in level. Yeah, that's a lot of difference in one day. But it's nothing compared to the difference the lake is going to experience in 5 years. We don't know if the lake is going to go down or up in 5 years. We just know, or the chances are, that the lake is going to experience a very large difference in level. If it's exactly the same as it is now, that's really unlikely. By the way, I'm not a king. I'm just wearing a blanket, okay? Sorry if it looks ridiculous. It's a little cold. But back on topic. Oh, it's actually blue. It's kind of matching the theme here. Back on topic here, before I get too distracted. The difference is going to be big. And it's very highly unlikely that the lake is going to be at the exact same level 5 years from now. And that is the same reason why options in general, puts and calls, are priced a lot higher further out into the future. If you go to the next week's options, they're not going to be very expensive. Okay, so first thing you want to do when you're playing around with options is to pick a date. So in this example, we have February 3rd, 2023, which is the nearest expiration date. Okay, so options, they expire after a certain amount of time. So you can pick which contract you want to play around with. There's all kinds of dates out here. Okay, when you go to a more liquid stock has nothing to do with the lake we're just talking about. Liquid stock just means that there's a lot of participants in the market of this particular stock, in the options market or in the stock market. And because there are a lot of participants, there's a lot more demand for all these contracts to be traded. Okay, so there's a large variety of dates. Some stocks do not have as much variety of dates. So Apple is one of the most liquid stocks ever. It's the largest company in the world, publicly traded company. I think bigger than Aramco. Maybe Aramco is bigger right now, but doesn't matter. In either case, the first thing you want to do again is pick a date. If you notice, now I'll show you that because February 3rd is really close to now, the option prices are not going to be that high. The option price is also called premium. Whether we're trying to sell a call or buy a call, the prices should be exactly the same. Now, there's a difference in the spread. What is a spread? Let's take, for example, the 146 strike price. Okay, it's the price that the contract is going to be signed at. The reason I say contract is because that's exactly what it is. You and another party on the other side of the internet agree, you do a handshake, that something's going to happen at this level at 146 in a week. What happens is yet to be determined. So back on topic. All right, you'll see that there's a bid and an ask, and the bid is smaller than the ask. So there's $5 difference right now. You got to multiply this number by 100 because every option contract involves 100 shares. So it's easy to do. You just multiply this number by 100. So you see that there's $5 difference between the bid and the ask. So it's not exactly 146. I'm sorry, it's not exactly 343, the price of the option. Right? There's a ask at 345 and a bid at 340. Okay? And this price here is just called, I think, the mark. Yeah, it's called the mark. The mark is basically splitting the difference between the bid and the ask. It's what you're most likely going to get, an approximate of the amount you're going to get if you're selling the option, and approximate of the amount you're going to be paying when you're buying an option. So you pick a date. This is the price of the 146 option, 343. If I pick a date that's further out, let's say February 10th, another week out, you'll see that the price of the option, the premium, rose in value. If we go even further out, let's say February 24th, it's no longer 300 something, it's now 535. If I go out really far out in the future, how about January 2024? You will see that there's not even 146 option anymore. The closest one is 145. And you'll see that it's $1,923. All right. So if you want to guess the level of the price of the stock a year from now, there's going to be a large sum involved. So buying or selling a call option. If you're buying a call option, you basically anything that's over 145 you're gonna get. All right, when January comes along of 2024, if the stock is over $145, you're gonna get all of those gains. Let's say it's 150. That means you're gonna get $500 dollars, right? 5 times 100. $5 times 100 shares. You're going to have $500 in your pocket. However, you will have paid $1,923 roughly for that luxury. Okay? So come January next year, you will be net negative $1,400, over $1,400, because Apple didn't rise as much. So even though it was higher than your strike price, the price that you picked, the level that you picked, you're still losing money. Now, if you still don't get it, that's fine. We're going to go over here on the lake, okay, an example. And I'm going to try to explain everything that I've drawn over here for you. We're going to be talking about from the perspective of selling a call option now. I just talked about buying call options. If you're selling a call option, it's a little bit more complicated. You need to start off with some capital if you're going to sell a call option. The person who's buying call options, they don't need any capital. They only need to cover the premium for the call option, for that contract. But if you're selling a call option, you need to have some kind of capital to back up that contract. All right, you need collateral. It's called collateral. This lake represents, like I went over, $1,000 worth of value. And it's also a lake that changes in level over the years. So like we talked about, let's take the 1 week example. All right, trying to guess the level of the lake after 1 week. Now we could be in a dry period, and so the lake might drop down to 900 from 1,000. It could drop down to, probably not likely to drop to 850, okay? That's really low. The lake is not going to lose that much water in a week, right? It's probably not even going to go down to $900. It might drop. It's probably, maybe drop like a couple inches, couple of dollars, maybe go up a couple of dollars if it rains. It's not going to be a big difference. And the options are priced accordingly, okay? It's a market for these options. There are active participants on both sides of the story here. Some people are offering $8. Some people are, offering $9, whatever. So there's an active market for each one of these contracts. It's important to remember that. So 1 week out, what would you guess the level of this lake is going to be? All right. Your job, basically, if you're going to receive this premium as a seller and not a buyer of the options, you receive the premium up front. Okay. Literally, when you sell that contract, you get this $29. All right. Let's say you draw a line at 1,000. You say, you know what? I think there's going to be light rain next week. And so I'm going to sell an at the money call option with a strike price of 1,000. At the money means whatever the price, or really close to the price of the stock is priced at right now. Since the stock is at $10 each or 1,000, strike prices actually should be $10, not 1,000. Sorry, it's my fault. So this is $10. And up here that would be 11, etc. Moving on. Well, I can't change that lower one. Oh, there we go. So this is 8.5. So the premium on the right, as you can tell, is $29. So I'm going to receive $29 if I sell one call option using this $1,000 of collateral, my 100 shares of whatever stock. I cannot sell these 100 shares until next week. I can't do anything. They're locked away. Okay? Your broker is going to take them, put them in a lockbox, and they're out of your control at this point. The only way you can gain control of your 100 stocks is by paying down that contract that you just sold. You need to buy that call back. You need to buy that contract back in order to get the key to unlock your shares from the safe and be able to trade them again. Okay? So that's what putting up something as collateral means. When you sell put options, you're going to be putting cash for collateral. When you're selling call options, you're going to be putting stocks for collateral. All right. Now, because I'm selling an at the money strike price $10, which is the current price of the stock, I'm only going to receive $29 for that line drawing, for that contract selling, for that call option selling. $29 is still pretty good. I put that $29 in my pocket immediately, and what's going to happen, my account is not going to change in total value because I'm simultaneously going to get a credit of $29 and a liability of $29. So I'm going to get the price of whatever the premium is, but I get a liability of $29 because 1 week hasn't elapsed yet. And that liability can change in value by next week. It could go higher than $29. It can go lower than $29. As time goes on, it's more likely that that liability, so let me write it down here. So I'm going to get, let's pick a different color. So I'm going to get simultaneously a liability of minus $29 for the privilege here of selling that call option. All right. So far, so good. And that $29 will get erased by the end of the week. If, and only if, the stock stays at 1,000 or more. So the share price needs to stay at $10 or more. Okay? I'm sorry, or less. If the stock price goes over $10, I'll still get this $29, but my liability will increase quite a bit. Let's say it goes to $11. This will turn into $100. Okay, my liability will turn into $100 by the end of the week. What that means is my shares will get sold automatically. I will not see my shares again, and my $1,000 will be returned to me, and I'll also get to keep my initial cash here of $29. So by the end of the week, I will have $1,029. Okay, $1,029 total. If and only if the stock goes up. If the stock goes down, I get to keep my shares and the $29. And this liability will go to zero. However, my stocks are worth less now, right? So let's say the stocks go down to 900. Let's say the stocks go to $900. But I have the $29 that I've collected from the premium. So now my account will be worth $929. At the end of the week. $929. Which is not that bad, because if I didn't sell this call option out in the market, my account would be worth $900 now. It wouldn't be worth $929. So in one of the uses of selling call options is to decrease the damage of downside movement in your stock. So if the lake starts drying up, you have $29 worth of water that you can pour back into the lake. So the drought isn't as bad by the end of the week. You'll notice there's some other levels on there. Let's talk about a different level. Let's talk about an out of the money call option. You can sell one or you can buy one at $9. To buy a call option at at strike price $11 for next week, expiring next week, you only really need $9. That's why most of the option activities that happens out in the market is retail investors like you and I purchasing short duration call options, which expire in 1 week because they're priced so cheaply, right? It only takes $9 in this case to participate in the movement of 100 stocks. Okay, so that's all you have to pay is $9, and there's some chance that if the stock price goes over $11, you will benefit from all the gains of that stock past $11 for the price of that $9. So all you got to do is pay $9, which disappears immediately, right? And you will participate now in exchange for all the gains of 100 stocks past $11. So it's a very easy way to gain a lot of money, but it's also very risky. The chances of you succeeding by buying out of the money call options is low. Most likely is that $9 is going to get evaporated in a week and you'll never see it again. On the other hand, if you want to be on the other side of that equation, you can sell that same call option. It's called an out of the money call option at $11 strike price for next week, February 3rd. And you will, instead of paying those $9, you will now receive those $9. And as we talked about earlier, you will gain a liability of $9 as well. And that liability will evaporate with time, just like when buying a call option, it evaporates with time. It's called theta decay. In the same way, this option evaporates. It's not very likely, right, by next week to have a monsoon type of rain and fill up this lake all the way to $11. It's not a very high chance. And that is why we only get paid $9 for that. You see how that works? If this strike price was $12, this number would be even lower, and perhaps it could go down to 0 or a penny. Because the chances of this water filling up by next week is extremely low. I mean, how is this lake going to rise 2 feet in level in a week? It's not going to happen unless it's like completely constant rain and we get some kind of like India type monsoon here. If that doesn't happen, there's no way this price is going up this far, right? A lot of people, what you'll notice is that these option premium tend to get higher around different company events. For example, if the stock in question comes out with some kind of earnings numbers the next day or during this next week, or it has some other event like a product launch or something else like an acquisition or something like that, then because this event is so momentous for the company, these option prices will be juiced up. So instead of $9, it could be $50, it could be $90. The size of this premium, the fatness, the juiciness of this premium tells you that there is some kind of an event that traders are anticipating, and that is why the premiums are going up in price. The volatility or the amount of movement the stock is anticipated to have in the next week is very large. That's out of the money options. They're very cheap. You can sell them and they're safer. You're not going to lose your shares most likely. The other thing about selling out of the money call options is that you get to participate in the stock movement upwards. So if the lake keeps filling up all the way to 1050 or 1075, you don't lose those gains all the way up until $11. You get to keep your shares and keep the gains. However, you're only getting paid $9 for drawing that line, for selling that call option at 11, instead of the bigger, juicier $29 level that you would receive near the strike price, at the money, near the current price. So we went over at the money, we went over out of the money. Now we're going to talk about in the money. Selling a call option in the money. I've drawn a strike price at $9 here. So the premium on these stocks are going to be very high. The reason is it's going to be at least $100 in this example. So it's going to be $100 and something. You're going to receive that money up front, just like all the other options. And again, you're going to have a liability of $109, which again is going to evaporate with time. And the reason why it's so high is because you're drawing that line it's very unlikely event, right? Very unlikely that the water is going to dry up so much in a week. So because this event is so unlikely and you're forfeiting so much price movement, that this price movement is actually factored into this premium price. So that's why I said it's got to be over 100. Okay? Because it includes any movement between $9 and $10 or above. Okay? So if the price goes from $10 to $11, my liability would actually be over $200. It's the money. This liability represents the money I'm going to not get. That's why it's a liability. That's what I'm not getting, okay? As time goes on, this will start shrinking down. And if the price remains $10 in a week, like it is now, this number will go to, no, it's not zero. It's going to go to $100 from $109. Okay, it's going to evaporate only $9 because I'm still not going to participate in this zone here between the $9 and $10. You see how it works now? If I pick the strike price at $8.50, I would gain a liability of what? What is my liability going to be? It's going to be $155. That's right. $155. And I'll give you another quiz here. See if you can get it right this time. What is this number, this liability, going to be in a week if the price, which is $10 per share right now, has zero change in a week? What is this 155 number going to turn into? It's going to turn into $150 because it represents the difference between 8.5 and $10, right? We multiplied that difference by 100 because we have 100 stocks. And each contract in the options world is traded by 100 stocks each. It's important to remember that. Now that you know this, let's go back to the options wheel here and look at some examples. Let's go to February 3rd. Now that we know how it works, let's see if we can put everything down on paper here. We're talking about selling or buying call options. It's really the same price, right? Just remember that. There's two sides of each contract. You can be a seller or a buyer. We were just talking about selling call options. So the price of Apple stock right now on January 27, 2023 is $145 $1.98. If I wanted to sell, right, a call option that is, I was going to pick an easy number. How about 140? So what would I be selling? Am I going to be selling out of the money, at the money, or in the money call option? Correct answer is in the money, because it's below the level of the price. It's below the level of the lake. So I'm going to be selling in the money call option. So the premium is going to be at least $500, because it's $5 away from the strike price, and then the extra premium on top, which is going to be, in this case, $265. So if I sell an in the money call option, I'm going to receive that $500, which is the difference between 140 and 145, the current price, or let's call it 146. So $600, and then an extra $165 worth of premium on top of that. You see how it works? So the total amount I'm going to get is $765 if I decide to get that 140 option. Okay, $765. Now, what would have to happen here? What are the different scenarios that can happen by February 3rd? Scenario number 1. The stock price stays above 140. In that case, what would I be doing? I would be forfeiting all of the gains above 140. So let's say even if the price is 200 next week, I will not gain any of that. The price is 300. The price is 1,000. I don't get any of those gains, because I've promised that I'm going to be selling these shares at 140 if they're at 140 or above. These shares are gone. Okay, the price is above 140, no matter how they're priced. However, I do get to keep my $765 if it's any consolation. In fact, Robinhood and a lot of other brokerages are so nice to tell you that your break-even price is $147.65, which is basically the strike price that you've picked plus the premium, right? So you get up to 140 per share plus the $765, excuse me, which is a total break-even price of $147.65. That is to say that you break even, right, at $147.65. Pretty easy to understand. It tells you here what kind of percentage change that would require. And over here, I don't know how they derive this number, but it gives you a chance of profit. Yeah, I'm not sure how they derive, but this is kind of irrelevant here. I wouldn't look at this one. But what I would look is how much price change would be required for this scenario to like play out, which is $1.77 in this case to the upside, if I'm going to start losing out of this trade. Let's take a different scenario. How about instead of selling a call in the money, we sell a call, oh, look at this. This is crazy. This is actually happening. Look, I've already sold 2 contracts for Apple at 150. I was just going to give it an example for that. So if we sell an out of the money call option, I would receive $166 here. If it was at the money, the more at the money you are, the higher the premium. Okay? That's how it works, because that is harder to guess. If we go back to the sketch pad here, it's harder to guess the level of the lake in a week if it's around the current price, right? And it's really easy to guess if it's way far out. All right, like how much would you want to get? Would someone get paid if they drew a line right here? The answer is 0. Okay, because the stock ain't going down to like $10 next week. It's not gonna happen. Okay, so you would not get paid anything for guessing that. So the closer to the current price you are, the more you benefit, the higher the premium is. Okay, as we go further out, if you see 150 here, 155 is only $53. 160 strike price is only $15 for February 3rd call options. Let's go back to this example that I've already done. Okay, I've sold 2 call options at 150 strike price for February 3rd. Now, what are the possible scenarios next week? When time comes, when February 3rd comes rolling around and the stock price of Apple is $155, I would not be able to benefit from the gains between 150 and 155. I would be forced to sell my 200 shares of Apple at 150 and collect the premium of 166 times 2, which is 332, is it? Dollars. And that's it. I get the cash. So 150 times 200 shares and 166 times 2. That's the cash that I would receive in my account. But I would not get any of the gains above that level. Even if Apple is at 170, 200, someone else is going to get those gains. Now, who is that someone else is going to get those gains? That's right, is the person on the other side of the trade. The person that bought the call option. You see how that works now? When you buy a call option, you're participating in all the gains above a certain level, and you pay a premium for that. When you're selling a call option, you're the one selling that premium, so you're forfeiting, okay? You are forfeiting the gains above the strike price to whoever buys that contract from you. Put options are very similar to call options, except they're a bit to the downside. Okay, and instead of stocks, you're gonna have to put up cash. I would like to walk you through put options right now, but it has to do with basically the inverse side of the equation. All right, so let's take a look at it in Apple's case. So put options, you see that this kind of changed here. The pricing changed. Call options and put options sometimes are priced differently depending on expectations of the stock market. Now again, if you buy or sell put options, the price should be very similar. In fact, the mark price should be the same. All the price should be the same, right? Because they're just two sides of the same transaction. The only difference here is when you sell a put, you are basically promising that you are buying this stock at a certain level or below if it reaches it. Okay? So you're still trying to guess the level of the water in the lake, but in a different way. So I would have to put up lots of collateral here if I wanted to sell the 140 strike price put option. I would have to, my broker would have to take my cash, put it in a lockbox, and I cannot access that cash at all until I buy that contract back. This contract is kind of like the key to the box. All right. So if I wanted to sell a put option, I would have to put up $14,000 because the price of the stock is 140. I'm going to times that by 100 because every contract is a contract for 100 shares of a specific company or an ETF or something like that. And I would get paid for that $127 for that week. All right. If the price drops below 140 in a week, I'll be forced to buy those shares. And if the price is above 140 in this week, I keep the premium and I don't get to participate in the gains. Again, I forfeit, right, my opportunity to buy these shares, but I get paid for that. So that's selling. Buying a put is basically the other side, all right, of this transaction. I don't have to put up any collateral. So buying options in general is much easier because I only need to pay this premium. In this case, for the 140 strike price, I need to pay $127, and I get to participate in the downside movement of the stock. Okay, so as the stock goes below 140, I actually get paid. It's kind of like, you can think of it as the inverse of call options, if it helps you a little bit. And if the stock is above 140 by next week, I get to lose my collateral. You see? So I'm basically on the other side of the person selling the put option. If I'm selling the put option, I have to buy the shares no matter how low they are. Even if they're $2, I have to buy them. Okay? So I lose basically $14,000 minus, 2 times 200 minus 400. I'm going to lose all that money. Okay, I've put it up and I've promised to buy them at 140 no matter what the price is. You see what I'm saying? Even if it's, like I said, even if it's $10 a share next week, Apple drops to $10 a share, I have made a promise by selling that contract that I will buy 100 shares of Apple at 140 by February 3rd. No matter what the price is, I have to buy them at 140. And for that promise, I get paid $127. Okay? Buying put options, you paid that $127, and somebody has to basically purchase these shares for you, and you collect the difference between the promised price and the actual price. It's a really good way to participate in downward movement of a market. But again, you're still drawing levels. It's all about drawing a level, picking a line somewhere in the sand, in the water, and letting things play out. Okay? So selling calls and buying puts is bearish. Okay? You're working the downside of the stock. And buying calls and selling puts is kind of bullish because you benefit if the stock rises. All right? Not in opportunity cost, but in just actual monetary terms. Now, hopefully some of this helped. I know it's been a very long video, and I'm sorry for that, but hopefully it made things clearer, and the terms were not awfully, complicated. But if you have any questions about options and how to understand them with this analogy, with other analogies or whatever, I'll do my best to explain it. Ask your question in the comments below, and I'm usually pretty good at answering comments, so hopefully I catch yours and we can talk about it. All right, hopefully that helped a little bit. Good luck all to all your option trading. Peace out.